Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
And we did get this morning, Anne-Marie, a response from China.
Yep, the Ministry of Commerce coming out and saying they vow to take measures to defend their rights. They say that they resolutely oppose what the U.S. is doing this morning with these tariffs. They say the decision is, quote, political manipulation, and also, Lisa, urging the U.S. to cancel the extra tariffs and correct this, quote, wrongdoing.
Let's see whether that works. Joining us for the rest of the hour is former National Economic Council Director Gary Cohn. Gary, so much to work through here in terms of whether it's tariffs, whether it's the fiscal policy, or whether it's the deficit. I want to start more broadly. This question of how much are from some of the fiscal policies directing investment theories right now in terms of where some of the money is going and what gates are being put up.
Well, look, fiscal policy and monetary policy are directly impacting how money is being spent, what money is available today. And I think that's even a more important topic. You know, we have gone through a pretty vicious cycle over the last 4 years where we went from a cycle of zero interest rates and abundance of capital available for almost all startups in this country and funding at various stages of your progression from startup to early stage to mid stage to late stage to IPO, to a place where we are today, where there's very little investment capital available for young companies and startup companies, and the IPO market just starting to reopen. So that is all a function of fiscal policy, monetary policy, because they're inextricably linked. You know, when people were not getting a return on their capital in the bank, and there was a zero risk assets out there, you know, people bought assets they thought could provide an enhanced return for them. So they were willing to take more risk. They were willing to invest in startup companies. Today, you can go out and buy a 6-month treasury bill and get 5.3, 5.4% on a tax preferential asset. So we have changed the whole mentality of the way people think about holding capital, investing capital, recirculating capital. Also, with the capital markets having been closed for so long, a lot of that capital that was invested 3, 4, 5, 6, 7 years ago, many of those people thought it had a 3, 4, 5, 6 year duration. They would get liquefied by taking those companies public, and then they would recirculate that risk capital back into the financial markets. They have not been liquefied because the capital markets have been closed, so therefore, that risk capital does not get to recirculate back. So a little bit of the natural cadence of capital moving in and out of risk assets has changed both because of fiscal policy and monetary policy.
There's a lot to unpack right there. Are you basically saying that on the monetary policy side, low rates usually benefit the smaller, more leveraged companies? Rates go up. That benefits more some of the larger companies that are able to be sort of term out their debt structures in a more considerable way. Are you saying that fiscal policy also benefits the bigger companies more because they're the ones that are eligible for some of these grants?
I didn't really say what you're saying. I don't think higher rates help anyone.
Okay.
Like if you're a large company and you're still running a large debt portfolio, you're always worried about your weighted average cost of debt, your WACD. So you're thinking about what that is, and the lower it is, the better it is. You know, ultimately at the end of the day, you know, you sell your goods or you sell your services to your customers. Then you've got your expense line, which is usually the biggest line in the expenses is salaries and costs. But then if you get down a little bit down, cost of debt is a big item. So to the extent that cost of debt goes up, the price of your goods or service has to go up. So companies, you know, either their profit margins contract as interest rates go up, or they have to raise the price of their goods. So in a perfect world, no one really wants interest rates to go up. But there is a sort of middle ground where interest rates are at a level low enough where they're not really affecting. And the economy is growing without fiscal stimulus from the federal government. The question is really more when fiscal stimulus from the government comes in, How does that react? And right now we actually have one of the most unique periods of time because we've got, on one hand, we've got the Federal Reserve, which is trying to raise rates to slow down economic growth, to get inflation under control. And we've got the federal government on fiscal policy on the other side looking to invest capital to grow the economy. Those two things are countervailing forces. We don't see a lot of times in our economic history when we've got both of those things going on at the same time. Usually we're in unison. Usually the Fed's trying to grow the economy by lowering rates, and the government is trying to spend money to grow the economy. That's normally what you see as you're coming out of a very tough economic period. When you're in a very robust economic period, the Federal Reserve is raising interest rates, trying to slow it down, and the federal government does not need to spend money because you're in a very robust economic time. This time, it's very different than the historical past.
As an investor, who do you bet on winning? The Fed or fiscal policy?
I don't know if there's a winner or a loser. I think you have to be realistic to what's going on and who's trying to do what. The Biden administration has been pretty consistent on their fiscal policy agenda. They have been trying to spend money and put money into the economy since day one. Since the first COVID relief, $1.9 trillion they put in early. And they continuously find ways to put money into the economy as recently as relief of student loans. So they're continuously looking at ways to fiscally stimulate the economy. The Fed, on the other hand, is responding to the outcome of that money being put in the economy. There's a cause and effect. Many of us think the effect is so much money being put in the economy, the money supply expanding so quickly that you've got too much money chasing too few goods. And therefore you had an inflationary time and inflationary pressures. So the Fed is responding to the effect of the cause, and they are raising rates trying to slow that down. So if I were going to bet, the Biden administration will continue with fiscal stimulus. In fact, they have a lot of stimulus already approved where they have not given out the money, so that money has not fed through the economy, and the Fed will continue to monitor the financial conditions and most importantly, they'll continue to monitor the path of inflation based on the data that they get, and they will decide what rate policy looks like based on that.
Gary, I want to ask you about the next fiscal fight, which is the Trump-era tax cuts. They're expiring next year. Do you think they should be extended?
So, look, I think tariffs is one of the most interesting topics that we dealt with when I was in the White House, and I think the Biden administration is dealing with now. It's interesting, despite a lot of rhetoric, the policies are starting to bend toward each other. It's hard to know the difference between the two, let's call them candidates' policies today.
Do you agree with tariffs? Because they're inflationary.
I'll talk about tariffs. So when you look at tariffs and you think about tariffs on things that we manufacture in the United States and we can sustain ourselves, I think it makes sense to tariff a country that is importing things in the United States at a below cost. So we know that China has some real economic advantages. We know that they don't pay fair market labor. We know that they don't have a cost of capital. We know that they don't have environmental restrictions that U.S. companies have. So we know they've got a competitive advantage. So if they're using that competitive advantage to dump products in the United States that we make, and therefore they're displacing U.S. manufacturers and U.S. jobs, yes, we should protect our border. On the flip side, if they are exporting and we are importing goods that we need, that we do not make in the United States, and there's no replacement for us in the United States, and we put a tariff on it, it basically becomes a consumption tax. You and I and all of us are going to buy those products. We're now just paying more for the same product.
Do you think that we're going to see more of these walls go up, whether or not Biden or Trump get in the White House next year? Like, how high are we talking?
I think there's a thought right now that the wall should go higher. I think at some point there is diminishing returns. We've got a lot of historical data on putting tariffs in, whether there were old steel tariffs under other presidents. When I was in the White House, we did a 301 on washing machines. And if you look at the whole theory of what happened with washing machines, it's quite interesting. We put tariffs on washing machines, but the prices of dryers went up equally with washing machines because, the manufacturers think, well, people think washers and dryers cost the same thing, even though one had tariffs on it and one didn't. Very inflationary. to buy a washing machine and a dryer. Did it bring manufacturing back to the United States? Yes, it did. We brought the foreign manufacturers, the LGs and the Samsungs that were importing in the United States. Did they open manufacturing in the United States? Yes, they did. So we did create some jobs, but we really increased the price of the washing machine and the dryer. So there's a lot of historical data on what happens when you tariff things.
WTI hovering around $79 a barrel as traders await OPEC's next move and inflation data. Meanwhile, on the other side, copper touching its highest level since 2022, fueled by forecasts of a global supply deficit. Jeff Currie of Carlyle joining us now. And Jeff, that's where I want to start. Traditionally, people focused on oil prices. Right now, what we're seeing is oil steadying, but we're seeing the rest of the commodity complex surging ahead, up some 8.2% since the end of February. What makes for the divergence?
Copper is the new oil. We put out a piece back in 2021, making these bullish arguments. And by the way, they haven't worked out. But I talked to a lot of people who will say copper is their highest conviction trade. I wear my copper bracelet right here. It is the highest conviction trade I've ever seen. If you've got decarbonization, green CapEx demand, AI, data center demand, military demand. It takes 12, sometimes 26 years to bring on new supply. You can't come up with a better story. But the bottom line, we've been telling this story for 3 years, and maybe now it's beginning to work. I'm confident that this time it's liftoff, and I think we're going to see more momentum behind it because you have three sources of demand this time around, meaning green CapEx, AI, plus military. Back in 2021, all we had was the green CapEx demand, and now it's in full force. Supply's not there. Inventories are tight.
Prices have more than doubled going back to March of 2020, and I'm looking right now. How far more is there to rally at a time where you're still wearing your copper bracelet?
I think, our target was $15,000 a ton when it's trading, just a little bit above 10,000 as of this morning, which means, it's got a long ways to go. Where do we come up with that 15,000? It was the highest real price ever reached in 1968 during that housing boom. So we don't know where demand destruction occurs. All we do know is that bringing on new supply is very difficult. So we're going to learn where those price levels are, where you begin to kick out demand. But I go back to the 2000s, and as bullish on oil then as I am copper today. Oil ended up going up from 20 to 147 times. So, the upside on copper here, I think, is very significant.
We're seeing a lot of supply when it comes to countries outside of OPEC plus, Jeff. Do you think that potentially we're on a bearish trajectory when it comes to the oil market for this year and next?
Absolutely not. One of the big sources of oil supply over the last 18 months came from sanctioned countries. Venezuela, Iran, Russia. Yes, they've attacked these sanctions and clamped down, but they don't come into effect until after the election 180 days from now. So that's been one of the big drivers. And also in energy, don't forget the massive surge in coal production that occurred in China, Indonesia, and India over that same time period. So there's a lot of energy in the system that has backed up that needs to be eaten through. When we think about the underlying demand, it's not spectacular like it is in copper, but it's rock solid. It's well above long-term average growth rates. You're going into the gasoline driving season, jet fuel, and by the way, remember, global warming means your cooling season is going to create more demand in the past. We didn't build inventory, so that 3Q bull story is still very much intact, driven by fundamentals, even without any geopolitical risk priced in. Also on oil, I want to note that when we look at positioning, it's down to the 14th percentile. Now, this market is basically no long positioning in it right now, and we're still sitting at $83, $84 a barrel, which is a testament to the underlying strength. Putting it all together, I want to emphasize commodities are still the best performing asset class despite the pullback in oil prices.
Jeff, let's talk about gold for a moment. I'm not wearing any gold that I can hold up, but it's a time where investors can get real yields in short-term parts of the market. Why are gold prices still going up, and how much of that is activity by the central bankers?
Well, I think a big difference between this commodity rally in any other commodity rally most any human being alive has ever seen before is it's not accompanied with dollar recycling. Meaning, think about, the petrodollar system. Oil prices go up, Saudi Arabia accumulates more dollars, they plow it into U.S. treasuries, puts downward pressure on rates, dollar begins to weaken, which reinforces the reflation, and it becomes a virtuous cycle between oil prices and the dollar, reinforcing higher commodity prices. That's not playing out this time. Why? Because many of the BRICS countries back in November of last year decided to start to trade with one another using local currencies and then settle the differences in gold. So what we've replaced dollar recycling with is gold recycling. And that has created this uptick in gold despite a stronger dollar. Normally, you would look at the fundamentals today and you would go, oh, gold should be going down. Real rates are higher, dollar is stronger. Those are all the dynamics that put downward pressure on gold. Instead, gold's going up. What's driving it is that strong demand coming out of these emerging markets where they're now recycling into gold as opposed to U.S. Treasuries creating that dollar recycling theme. So this still has more legs to it. We see more upside in gold prices from here.
I guess, Jeff, what we're trying to get at is there are some stories that people have been bandying about all year, whether it's the EV transition or some of the grid build out that's going to require more copper usage, whether it's some of the central banks shifting more to gold. Why do they have so much further to go if it's a lot being priced in and speculators coming in and trying to get ahead of them and bidding it up even further? What gives you a sense that there could be a catalyst for another leg higher in the near term?
Because you need to destroy demand. Right now, you're running on fumes of very low inventories, particularly of copper. You have no way to bring on new supply. Once you're out, when prices begin to spike, they got to spike high enough to bring demand back in line with supply. That's where we're going to find out where that elasticity of demand really exists. The only one we can ever observe is going back to the 1960s, which suggests maybe it's 15,000, but we really don't know. We're going to find out. We didn't find out in the 2000s bull market because China was never forced into a situation where it had to consume and you had to ration demand out. That's why we peaked out in that $10,000 a ton range, similar to where we are right now. So going forward, no inventory. Remember, really strong demand from all those sources you talked about. There's not enough to go around. Somebody's going to have to drop out, and that's where we're going to find out where the high print is on this market.
Jeff, if I could just go back to your answer earlier on the oil market, and you see this very bullish market happening, and you see potentially we're not even at peak driving season. If we do see gasoline prices in the United States go past $4 a gallon, are you expecting the U.S. to tap the SPR?
Yeah, but there's a lot of other levers they can pull to put downward pressure on oil prices. That's why, I'm far more bullish on, base metals, copper, than I am on oil, particularly until you get after the election. Because, when you look at what drives elections, what drives the populist focus, it is the economy and inflation. So keeping oil prices and gasoline prices under wraps, over the course of the next 6 months, I think is going to be critical to the administration and the government. And we've seen this play out election after election. So I can't see why this one would be any different. What does that limit, on oil? It means you can get up into the high 90s. Maybe, you could top over 100 or something like that in the midst of the cooling season. But, would it be lasting? No, it's not like the underlying copper story where it doesn't really impact the underlying inflation. Now, you throw in something like some surprise problem in the Middle East or something like that, that could open up the upside. But I think, you're going to see governments around the world doing everything they can to fight this. And one of the ways is, turning a blind eye to, sanctioned oil, sanctioned products. So there's a lot of methods other than tapping the SPR that can be used to, also relaxing environmental regulations. We've seen them use that in the past as well. So there's lots of tools at their disposal.
Jeff Currie of Carlyle, thank you so much. Keep wearing that, copper bracelet until you hit 15,000 or bust. Thank you so much. slightly down, but this is a market that really is on hold as we wait for some sort of sign of a catalyst of whether we're heading toward that immaculate disinflation, or maybe not immaculate, but at least a soft landing versus stagflation. Brian Levitt, who is with us for the hour, I want to ask you about the latest Bank of America fund manager survey, which came out and showed investor optimism at some of the strongest levels that we've seen going back to 2021, even as investors are expecting a deterioration in earnings and a deterioration in the economic growth trajectory. Is this entirely dependent on the Fed cutting?
Well, it's not entirely dependent on the Fed cutting. As I had already said, if you look at years like 06, you look at years like 2019, or even now, market can do very well with the Fed on hold. So the good nominal growth environment has been supportive. I do suspect, like the Bank of America survey says, that things will slow. And you think about slowdown, we'll see if the Fed feels comfortable cutting within that. I think they would like to. But I think what investors are looking to is over the next few years, we're going to be normalizing the yield curve. And if you can normalize the yield curve without having had a meaningful disruption in economic activity, that should be a positive. I've said over and over that peak inflation, peak tightening, peak interest rates over the next few years should be good for equities. And I continue to stand by that.
Which is the reason why in this fund manager survey, Anne-Marie, we did see this optimism of several rate cuts this year, even with a deterioration in backdrop because of this promise of potentially peak yields. Michael Hartnett over at Bank of America did raise the specter of stagflation, which is something that Jay Powell has shrugged off, laughed off. There is no stag, there is no inflation. This is the biggest headwind right now that a lot of people say to equities.
A lot of people are saying this to equities. David Malpass, former head of the World Bank, this is his whole thesis into what we're actually seeing in some of the data he's looking at. But I look to the Global Fund Manager Survey sentiment not as close eyes and sell levels, but risk assets are vulnerable to more evidence of stagflation. Brian, do you see any evidence of stagflation?
Well, I like the way Lisa put it. And I was going to say, I don't see stag and I don't see inflation.
Well, that's Jay Powell.
Exactly.
So let's start with inflation. If you look in the bond market, whether it's the 3-year break even, the 5-year break even, the bond market's expectation for inflation, they're all very stable, very much within the Fed's comfort zone. Now, with regards to stag, it's certainly not a stag economy. Are things going to slow? Well, yeah, that's ultimately what we wanted to have happen. As things slow, inflationary pressures should moderate. You're already starting to see it. When everybody talks about the momentum of inflation over the last few months, hasn't been too much on the consumer side. Very critically, it hasn't been wages. Wages have been generally benign. It's been a lot of import inflation. And what are you starting to see already with commodity prices? What are you starting to see with oil? It's kind of moving down. And so I think that what ends up happening when we get to these pivot points, and Lisa, you started the show with that pivot point, people, for whatever reason, think of the worst environment that they can imagine.
Catastrophic
right?
thinking.
Yeah, it's
They're
like
watching Lisa.
It's genetic. Carry on.
Well, she just said pivot. She didn't say catastrophic. All of a sudden, it's going to be the 1970s again, and yet this is a very different environment. If you look at the misery index, which is the unemployment rate plus inflation, it's historically quite low. Right? That doesn't suggest stagflation. Now, could it move? Yeah, but what direction is inflation going? I don't think it's heading higher here.
Part of the problem that a lot of people are looking at, including Philip Jefferson yesterday of the Fed when he was speaking, is we just have seen this persistency to inflation. Yeah. And what we have seen is an actual acceleration, a re-acceleration in the first quarter inflation data versus the last quarter of last year. This could be year-over-year comps, but you take a look yesterday of the New York Fed Consumer Sentiment Survey and inflation expectations, and you could see they are creeping higher. And it's not just broad-based, but also for home prices, which were supposed to be the most affected by keeping rates where they are. So at a certain point, you have to look at that and say, hold on a second. We can dismiss this as going to be disinflation, but we expected that pivot point last year. We expected that pivot point 6 months ago. If you ignore what the data is actually showing, that will be another error.
Correct, although the question is, when we see things ticking up a little, they're off of low levels. Some of it's being driven, or relatively low levels, some of it's being driven by commodities, and some of it's likely being driven, if you look in the Consumer Price Index report, by some of the lagged effects of shelter. Housing and rents had come down over a year ago, particularly rents. I mean, I don't know which one we want to look at, but if we believe the Zillow numbers or others, those rent numbers should be down by now, so it's not being captured necessarily in the Consumer Price Index. Fed's preferred measure of inflation below 3%. That's the core personal consumption expenditure. As I mentioned earlier, the tips break-even's relatively benign. So I think I wonder if the consumer, when they're being asked, are they thinking about the high cost of living, which is now part of our life, or are they thinking about the change and the change in the rate of change? It's kind of like everything I learned I needed to know in kindergarten, everything I learned I needed to learn in calculus class. So ultimately, this is going to, in my opinion, it's going to moderate. We'll look back and say, remember, we were worried that the economy was too strong, the consumer was too strong, it was all inflationary. Then we'll be in a slowdown, and the market will, do a 10% decline in a slowdown, and we'll be saying, gee, I really miss those strong nominal growth days.
The thing is, though, and when Lisa brings up the New York Fed one-year inflation expectations, the survey, the bank said that respondents project inflation a year from now at 3.3%. That's much higher than where we are today. How much does that inflationary concern on top of consumers' minds change how they're potentially going to go out and spend the remainder of the year?
Well, you're starting to see, if you look at the Michigan survey, the consumer is starting to say that these prices are becoming, somewhat problematic. And so remember, the recent move, we've had a move in oil prices, we've had a move in gasoline prices. Those are starting to moderate, at least on the oil side, starting to moderate here. And so remember, we started this by saying, can the consumer hang in? Right? And the consumer's saying things are likely to slow here a bit. You saw it in the Home Depot numbers. And so we shouldn't be, well, on this side, the sentiment says inflation's going to keep going, but the numbers are showing that they're moderating. Again, from our perspective, if we look at the consumer momentum, pretty benign, wages pretty benign. A lot of it has been this import price inflation that now seems to be moderating.
You mentioned Home Depot. Let's just give you a rerun of that. If you are just joining us, they did report earnings. Comparable sales coming in light, down 2.8% versus the estimate of 2.2%. You could see customer transactions were down about expected, about 1%. The key here and why you're not seeing a bigger move really is that they still keep all of their 2025 year forecasts. The comparable sales about still down 1%. Sales still increasing by about 1%, earnings per share growth about 1%. So this really does seem to point to stability, as we heard from Brian. Here is also this idea that, yes, there is a softness due to people maybe not moving, they have already done a lot of the home improvement, but there is this sense that people still have money to spend. If there is one takeaway, Brian, from this earnings season, what would you say it is?
It's a mixed picture, but I would say the biggest takeaway is that everybody thought we'd be in a recession by 2023, and we're still growing earnings 10% in the quarter. And so it's still a good nominal growth backdrop. And everybody's worried whether inflation's 2.8, 3%, 3.3. Remember, businesses make money in nominal terms, and so a good nominal growth environment is supportive for corporate profitability. And what I say to investors, if they were so worried we'd be in a deep economic downturn by now, the reality is things still are good and companies are still benefiting. It's mixed, right? We're seeing more from tech, we're seeing more from financials than perhaps energy or some other parts of the market, but again, another good earnings period.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.